Okay. All right. Remember at the beginning of the semester when I said this class just sort of like just keeps moving, like you kind of get one concept and you're starting to get that down, and then there's another one, and it just keeps like dumping new concepts on you. So you probably noticed that by now. Like, I mean, we're going into another chapter, and that's true of almost any course. If you ever look in our catalog, certain courses are labeled as what's called a SUN course. Have you ever noticed that next to some courses? SUN courses are what that SUN stands for, shared unique number. And what that means is we have, by agreement with the universities and the other community colleges, all agreed that this course will be the same course at every school. Okay, so that the content will be the same. And so, like, if you're taking an SBM prefixed course here, those usually will transfer to the universities or to the other colleges as like elective credit. So you can, take a SBM 211, which is financial management, and that will go to ASU as an elective and in the business department. Okay, but if you take accounting, our accounting, it's going to be the same course as you would take at ASU. I teach it for BYU, which isn't part of our shared unique number system, but it's the exact same curriculum there as well. And so those courses are usually a little more robust because it's like there's all this input of lots of different groups saying we want it to have at least this. And so in the end, it ends up with a lot of information. All of our math courses are SUN courses, right? So if you take calculus, you're going to be getting the same content. Might be different teachers and different ways of teaching it, but same content. So anyway, that's why one of the reasons this course moves so quickly. Just as a wonderful ray of hope for you, though, accounting 2, so uses of accounting 2 that most of you will probably take next semester, is a slower paced course than this. Okay, this I feel like they're trying to get all of the initial concepts in, and then it slows down, and it's managerial accounting, which is it's a little easier, I think. So that's good news, and it only meets Monday, Wednesday, Friday instead of every day. So that's good. So this today we're going to talk about fixed assets, and by fixed assets we mean assets that are long-lived, as opposed to something like cash, which is liquid and meant to be spent, or supplies, which are meant to be used up, or prepaid assets, which are meant to be used up. These are assets that we use up, but we use them up over a longer period of time. Common forms of fixed assets are things like buildings, machinery and equipment, and land. Okay, there's other things as well, but these are the most common ones. So the first question from an accountant's viewpoint is, what did the asset cost? We need to understand what an asset costs so we can deal with it. And that's easy if you buy something like, a piece of equipment that requires no setup. You just have this piece of equipment, right? Then it costs what you paid for it. But what if you're building a building? What costs of building it go into the cost of the building? So things like, if when we built this building, as an example, this used to be an old administration building back in the day, and then it burned down, but some of it was still salvageable. So people wanted to like tie in the history of the old building together and make it this new modern facility. So we hired an architectural firm, right? So those costs are part of the cost of the new building. Engineers' fees, insurance costs, the actual cost of construction, all of those things. So what you need to understand is, to figure out the cost of an asset, it's pretty much any cost of getting that asset ready to use. Okay, I'll give you an example. When I built my storage buildings for my rental storage business, what I did is I just created an account that was like building costs. And then every time, so I would pay a concrete company, and they came and they poured the footer and the slab, and I would pay them. And so I would debit my building cost and credit cash. Okay. And then I hired my nephews to come help me put up the steel structure. Any money I paid them, I would debit building cost, credit cash. Finally, at the end of that whole process, I had the permitting fees and all the costs of paying people, the cost of the materials, all of those things had added up to a certain amount in that account. And when I was ready to put the building into service, meaning start using it for a business purpose, at that point, I did a journal entry that debited the asset building A, that was my incredibly creative name for my first building, building A. The second one was called, no, it was called building C, actually. There was a gap where I was going to build another building later. So I was, it was confusing. Anyway, my wife was like, why C? Because B's in the middle of A and A. All right. But it's when I was ready to put that. So I debited building A and then credited building costs. Building costs was gone because it was just a temporary account for me to track all those costs of building it and then set the price. Then from then on, as I did depreciation, which we're going to talk about today, I would base it off of that initial building cost. Okay. So recognize there's a bunch of costs that go into what the actual cost of an asset is a lot of times. Okay. And then there's this separate thing that we call land improvements. And we have to be careful. So anytime you think about it, if you go to any building around town and they have a paved parking lot and they have curbs and they have trees and shrubs and fences, all those things, we should track those separate from the actual land. And we call that land improvements. The reason is they usually have to be replaced or repaired before the building does. Okay, parking lots need to be repaired every few years, okay, as an example. So just know that we track improvements separate from the land itself. All right. So here's an example. Kimball Inc. purchased equipment for $12,000. Freight costs were $600 to transport the equipment to their installation site. Once they got it to the site, they had to install it. That cost $1,500. And there was this $500 extra cost due to an error in installation. So what they did is they went ahead and said, what was the total cost of this equipment? And they put all those costs, but they didn't include the $500 error. Instead, they took that as an expense right at the time. That can be really challenging at times. In real life, it's actually easier because you usually have some type of a policy in place for how you're going to deal with things like that. So when you have a problem, hopefully, Cengage will tell you, right, like this is an exception and we're not including it. In real life, seriously, you know what you would do? You'd walk over to the controller's office and be like, hey, do we want to charge this as part of the cost of the asset, or do we want to take this as an expense right now? So recognize that even I think when you first start studying accounting, you think, oh, it's like black or it's white. Either this is an expense or it's not an expense. And then the more you study it, the more you're like, there's like this iffy gray area. Like some things clearly are expenses and some things clearly are not. And then there's like this issue of like, you know, we had an error in the installation and had to pay this additional $500 to get it fixed. Do I want to charge that to the value of the asset, or do I want to take that as just like a repair and maintenance expense right now? And it will vary even by where you work, what their policy is on dealing with that. Okay, so just be aware that there's some ambiguity there. So we talked about depreciation a little bit already. Here's something I want to really try to clarify to you. When we think of depreciation, we tend to think that means that's me tracking an asset's loss in value. And that's not what we're doing when we're recording depreciation. Instead, what we're doing is we're recognizing the cost of the asset as an expense that is spread out over the asset's life. So if I pay $24,000 for a forklift, it doesn't really work with accrual-based accounting with the matching principle for me to immediately say equipment expense, 24,000, and cash, 24,000. Why doesn't that work? What's the problem with that? Yeah?
Because you'll be using it over a long period of time. So if you're having this thing that's not an expensive.
Right. That's perfect. No, so because because you're using this asset over a long period of time. You're deriving business value from this asset, maybe for 10 or 20 years. Forklifts last forever if you maintain them right. Right. Probably if you've ever run a forklift, it was old. Most like really janky ones, and you're like, I only can lift above this point because the hydraulic seals are anyway. That seems to be how a lot of heavy equipment is. So if you're going to derive financial benefit from something over a long period of time, it's going to be, and by deriving financial benefit, what I mean is ultimately you're getting value. It's saving you money. In the case of a forklift, it's probably, instead of having to hire 4 guys to lift a heavy thing, one forklift operator can lift the heavy things, right? So it's saving you money. That's why you have a forklift. So we should spread the cost out over that useful life. That way, we don't have this giant expense this year, and then we're deriving benefit from it for the next 10 years and no expense at all. Okay. So there's like 3 factors that go into calculating depreciation expense. The first is the initial cost of an asset. So what we just talked about, right? What you paid for it plus any costs of getting it ready for service. The second is what's called the residual value. This is some estimate as to what you think the value of the asset will be at the end of its useful life. Whether you intend to sell that, like if you're a rental car company, you buy cars, you usually only use them for a year or 2. You've noticed, right? If you ever get a rental car, it always seems like it's kind of new, right? And then they sell it. So the amount they think they can sell it for at the end of its useful life is the residual value. Okay, so that's what that term means. And then finally, the useful life, our estimate of how long this asset will be useful to us. Recognize that the useful life doesn't necessarily mean how long the asset will last. It might mean how long it will last for us. Computers at the college, we replace them every 4 years. Can a computer last longer than 4 years? Sure, it can. So what we do is, but we want to keep relatively modern computers with modern operating systems so that our students who are preparing to go into the workplace aren't using some 1980s computer and then going into the workforce not knowing how to use, the newest version of Windows and the newest version of Office. So the useful life is how long you intend to keep it for and use it for. Okay. Again, these are estimates. Again, we think of accounting as black, white, cut, dry, but it's pretty gray. We have to make a guess. We think that we're going to use this for 5 years. So if we think it has a useful life of 5 years, then what we're going to do is we're going to divide up that cost over the next 5 years. There's several different methods of how you divide up that cost. Okay. And we'll go through those. That's kind of the major learning point of this chapter, is learning some of these different depreciation methods. All right. So the 3 that we'll learn about are called the straight line method, which is kind of a method we've already seen a little bit as there was depreciation. The second is called a units of activity depreciation method. And then the third is called the double declining balance method. Companies are free by IRS standards to use one method for one type of an asset and one method for another type. And really, when people say, well, what method should I use? The answer is like, well, the one that best fits how you're consuming that asset, how that asset's going to need to be replaced. Okay. I will tell you that most businesses use the straight line method only because there's a schedule, a straight line depreciation schedule that's put out by the IRS called MACRS, or sometimes people call it Maker's Schedule. And I'm trying to remember what it stands for, Modified Allocated Cost Recovery System or something like that, some government sounding acronym. And so you can go on there, like for storage buildings, you can look up like non-residential rental buildings. And there's just like, they tell you this is the number of years in its useful life. And if you use that for preparing your taxes and creating your depreciation expense, it's almost like no questions asked. And so most businesses use that because it's kind of like the IRS has pre-approved this. You just use their thing. And since you're worried about pleasing the IRS, you're just done with it, right? You don't have to do anything more complex. But other businesses are like, no, we'd rather use some of these other methods. Okay. So let's take a look at the straight line method. We calculate straight line method with this formula. So you need to know this formula. You're going to use it a lot. Cost minus residual value divided by the useful life tells us our annual depreciation. So for the example of our forklift, it was $24,000. We think it will have a residual value of $2,000. And so we divide that by 5 years and we come up with $4,400. So each year of the life of that forklift, we're going to depreciate $4,400 worth of, we're going to depreciate $4,400 worth. Let's see. Recognize, sometimes it's helpful to recognize that with straight line, you can just calculate the percentage if you want, right? If it has a 5-year life, if you took 100% divided by 5 years, that would mean that you're depreciating 20% of its initial cost every year. If something had a 10-year useful life, took 100% divided it by 10, you would be depreciating 10% of its initial cost every year. That's just another way of looking at it, okay? So this is what, at the end of each year, we enter an adjusting entry that recognizes our depreciation. And this is what it looks like. We debit depreciation expense, so we get to take that expense. It reduces our net income. And we credit an account called accumulated depreciation. And you can see that there's usually a separate accumulated depreciation account for each fixed asset that you're dealing with, okay? Some businesses have so many fixed assets that there's companies that make specialized software just for dealing with depreciation of fixed assets, okay? You know, my business, I had 4 buildings, A, C, D, and E, okay? Someday I was gonna build B, but I never did. I never built it, then I sold the business. So, but I had planned to, right? I mean, that's how business goes sometimes. So really, like, there wasn't that much to track. But if you're a rental car company and you're tracking your entire fleet of rental cars and trying to keep straight the depreciation on each of those, if you're a, you know, any sort of company that has a massive number of fixed assets is going to need some sort of specialized software to do that, just to keep track of them all. All right, so accumulated depreciation is a special type of account. And I've mentioned this offhand before, but it's called a contra account. So accumulated depreciation is a contra asset account. All a contra account does is it's an account that has a normal balance that is opposite of what the normal balance would normally be. So assets typically have a normal balance on the debit side, but a contra asset then has a normal balance on the credit side. Contra accounts are also always linked together with a specific regular account. So a contra asset would always be linked to a regular asset, okay? And it helps us track what we call the book value of the asset. So I would have an asset called forklift, which would have a cost of $24,000. And then I would have a contra asset called accumulated depreciation forklift, which after this first adjusting entry would have a balance of $4,400. If someone were to say, what's the book value of the asset forklift, we would take the cost minus the accumulated depreciation. And so we would have what, $19,600 would be our book value at any given time, okay? So those are just some definitions that will help. After the second, yeah. Forklift, that's the asset. And then accumulated depreciation on the forklift is the contra account linked to the forklift asset account. Does that make sense? I'm sorry? So this is the cost. This is the accumulated depreciation, and this minus this. So the cost minus the accumulated depreciation will be what we call the book value. Yeah, and book value just means, again, it doesn't necessarily mean the resale value. Maybe we could go sell that forklift for $30,000 right now. I don't know, you know. So it doesn't mean market value. It just means your cost minus any amount you've depreciated. And by depreciated, I mean you've claimed a depreciation expense for it. Okay. And so we will keep doing that every year for 5 years. And at the end of 5 years, our book value will equal our residual value, the amount we think we're going to get when we dispose of the asset. Okay. All right. That's just an explanation of what a contra account is. And kind of what I just said. So the book value of the asset minus accumulated depreciation gives us the book value. Should put that up there first. It would have answered your question. Whoops, the little door was open. All right. So recognize that our depreciation expense using the straight line method is going to be constant, the same amount each year. That's why it's called straight line. And that our book value is going to be declining, right? Because as our accumulated depreciation account goes up, our cost stays the same. At the end of each year, our book value will go down. And by the end, our book value will be whatever residual value we factored in at the beginning. Okay, that's how straight line depreciation works. So the second type is something called the units of activity method. Recognize that not all assets are best depreciated by their age. Like maybe a car, if you only drive a car like 1,000 miles a year, it might last for, well, a really long time, right? I mean, 100 years or something. You know, I have cars. The car I drove to work today has 280,000 miles on it. And so sometimes years or the age of the life of the asset isn't the best way to track depreciation. So the units of activity method does the same idea, except it breaks down the useful life rather than in years. It breaks down the useful life in some units. For a car, that might be miles. For a piece of equipment, it might be machine hours that it's been operated or something like that. And so this is more flexible, and this is why some businesses would prefer this, because they want to track their assets by some unit of activity rather than just by time. So here's the process, or here's the formula: cost minus residual value divided by the total estimated units of activity. That'll be different for different assets, okay? And then that will give you a depreciation per unit rather than a depreciation per year. Here's an example. So the forklift costs $24,000, has an estimated residual value of $2,000, and it's estimated to have a useful life of 10,000 operating hours over the life of the asset. During the first year, the forklift was operated 2,100 hours. So under the units of activity method, how do we figure out our depreciation? So the first thing we do is we figure out our depreciation per hour by taking the cost minus the residual value divided by the total estimated units of activity in the asset's life. That gives us $2.20 per hour. So what we're going to say is we're going to claim depreciation on this asset at a basis of $2.20 for each hour of operation that we use it. Okay. Yeah. Mm-hmm. Yes. Yeah. So straight line we usually do per year. Okay. Could you do straight line depreciation per month? Sure. You just have to divide it out by months instead of by years, right? I mean, if somebody, I don't know why, if somebody wanted to record their depreciation on a monthly basis, nothing wrong with that, but usually it's done per year. All right, step two, once we have the depreciation expense per unit, then we apply that to the number of units we use this year. So this year we did 2,100 hours, so we take 220 per hour times 2,100 hours, and that gives us a depreciation expense this year of $4,620. So we journalize it just as a depreciation expense on the forklift, 4,620, and then we credit accumulated depreciation, 4,620. So the process is very similar to straight line, except we're doing it on the basis of whatever units of activity. The most common units of activity would be something like miles driven or hours used, something like that. Those are the most common types. Although even like copy machines, you know, like a paper copy machine, they have a little counter that just counts how many copies they've made. And so it might make more sense to depreciate that on the basis of, it's got so many copies in its useful life before we've used it up, right? So any asset, we can think of some unit of activity. So this one's going to be a little different because it's going to vary from year to year over how much, based on how much we use it. So it's not going to be the same amount of depreciation each year. So we can see, like in the first year we had 4620 in depreciation expense, and then 3300, then 5720. Again, just based on the usage of the asset. So the depreciation expense will vary using this units of activity method, and the book value will also still be declining. Book value always declines. It's highest when you buy it, and it declines down until you hit that residual value. Okay, the last one's the most complicated. It's called the double declining balance method. There's a whole family of depreciation methods that are declining balance methods. The most common is the double declining balance. So this recognizes that a lot of assets are used up more in their first year from a value or cost standpoint than in other years. It's kind of like if you buy a car and you pay $50,000 for it, and then you drive it around for 4 months and then decide, I don't really like this car, and you try to sell it, you're not going to get anywhere near $50,000 for it, okay? Because it's not new, and people pay that premium for a new vehicle. And so recognizing maybe in that first year, I use up a big chunk of an asset's value, and then declining amounts in subsequent years. That's the idea behind the double declining balance, is it lets you, it's called an accelerated depreciation method. You take larger amounts of that cost early on, okay? So here's the steps, 3 easy steps to figuring out the double declining balance. Step 1, determine the straight line percentage using the expected useful life. And so to do that, in step 1, is you take 100% and then divide that by the number of years in the asset's estimated useful life, okay? So if I have an asset that has a 5-year estimated useful life, I would take 100%, divide that by 5, and that would give me 20%. So in a straight line, I would depreciate 20% of the unit's cost, its cost per year in a straight line. With double declining balance, we're depreciating a percentage of the book value, the remaining balance of the asset. So we figure out the straight line, then we determine the double declining balance rate by multiplying the straight line rate by 2. So for a 5-year asset, if I decided it was 20%, I'm going to multiply that by 2, and this is going to be my double declining balance rate, 40%. Step 3, I'm going to compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. Okay. In the first year, the book value of the asset is its initial cost. So in the first 2 methods I showed you, we took this residual value and subtracted it from the cost, and then we used that as the basis for our depreciable value. With this, we're not going to do that. We're just going to use the cost, and then we'll make an adjustment at the end to leave us with the residual value, and I'll show you that process. All right, so Exeter Company purchases a new forklift, same asset, $24,000, 5-year, residual value of $2,000. And just so you know, this term residual value, sometimes if you like Googled it or something, you'll also see the term salvage value used synonymously with it. So just be aware there's other terms that people use. All right, so for the first year, to figure out how much our first year depreciation is, we're going to take the straight line percentage. So it's a 5-year asset. So to figure that out, I took 100% divided by 5, gave me 20%. That's how much in straight line I'd be doing per year. Then I'm going to double that to 40%. And then I'm going to multiply that by my book value. In the first year, my book value is just my cost. So I'm going to take 24,000, my cost, times 40%. And my depreciation expense for year 1 will be $9,600. So there's my journal entry. Depreciation expense on the forklift, $9,600. Accumulated depreciation forklift, $9,600. So no matter which method you use, the format for the journal entry is always the same. You'll just have different numbers depending on the method you use. Okay. So here's sort of a table that breaks it all out. So that first year they do 9,600. So our book value at the end of the year is found just by taking the book value at the beginning of the year minus the depreciation for the year, gives us our book value at the end of the year. That then will become the book value at the beginning of the next year. We're going to multiply it by that same double declining rate. That's going to give us the depreciation for that year. We'll subtract that from the book value at the beginning of the year to get the book value at the end of the year. Carry that forward, multiply that by 40%, etc. And then on the last year, rather than going through all that multiplication process, we say, hey, at the beginning of the year, my value is 3,000, or my book value is $3,110.40. I know I have a residual value of 2,000, so I'm just going to take as depreciation whatever amount I need to, so that I end up with my residual value. Okay, so this is the most complicated of the three methods we're going to learn about in class. When I say there's a family of these, sometimes they have like a 1.5 times double declining, and so instead of doubling the straight line rate, they just do 1.5 times it. Okay, and again, those adjustments are made on companies based on how they feel the asset is actually being consumed over time. Yeah. Yeah, so we take our book value at the beginning of the year, and we know that we need to end up with $2,000 because that's our residual value. So we say 3,000 minus X equals 2,000 and solve for that X. Yeah. Yeah, so that's what solving for the X would do, right? It would just have us subtract it. All right, that's kind of what I told you up front. We don't consider the estimated residual value until the end. Whereas with the other two methods, we put it right in at the beginning and then calculate our depreciation with it. So recognize that. So we'll see that we take, with the double declining balance method, the depreciation expense really, it's almost, if you were to graph that like an exponential relationship, right? It drops like that. For those of you in business statistics, learning about exponential probability distributions. So, all right, just like that. And then our book value, same thing. Book value always follows that same pattern. Okay. So there's the summary of the three depreciation methods. Like I said, that's the big new learn for this chapter. Recognize in the homework, they're going to throw you some curveballs, like maybe an asset doesn't get purchased on January 1st, but gets purchased partway through the year. So in that first year, it only has a partial year's worth of depreciation in the, things like that. Or when you sell it or dispose of it, you're not disposing of it perfectly at the end of your year. Because in real life, it'd be nice if you could purchase all assets on January 1st and dispose of all assets on December 31st, but it just doesn't work that way. And so look for those kind of like, I guess where they're taking the basic concept I've shown you, and then they're kind of extending it a little bit and forcing you to have to make the leap. All right, so there's a summary. All right. So usually when you have long-term or fixed assets, you have to maintain them. You have costs of just keeping the asset working. And so sometimes we have costs that actually will change the useful life of the asset. Okay. And so, or change the value or the cost of the asset. So those we call capital expenditures, right? So if I've got a building and I build a whole new wing on the building, that changes the building substantially enough that I can't just take that new wing and write it off as an expense right now in the current period. Instead, I need to add it to the value of the building and then readjust my depreciation from there. Okay. But other things like painting and regular maintenance, while those do technically extend the life of the building, it's considered part of the normal functioning of a building. So those are things that we would take as what's called a revenue expenditure, meaning we take it as an expense in the current time period right now. So questions to ask yourself are, does it benefit only the current period? Or does it benefit current and future periods? If it benefits only the current period, that's clearly a revenue expenditure. You'd probably debit repair and maintenance expense and credit cash for a journal entry like that. If it benefits current and future periods, if it's an extraordinary repair that extends the useful life, that's a capital expenditure, and we're going to debit the accumulated depreciation account. And if it is an asset improvement and adds serviceable value, then we're going to debit the fixed asset itself. Okay. Again, this will be easier when you can see an example of it. So don't worry too much. Just know that some costs we're taking as an expense right now in the current time period. Other costs we're pushing forward and either changing the value of the asset or changing the amount of accumulated depreciation that's happened on the asset. All right. So what happens when we get rid of an asset? There's a couple things we can do. When we no longer need an asset, we can either discard it. I mean, like literally throw it away, right? And that happens sometimes with like a computer. It's toast. You used it up and now it's trash. Or we can sell the asset, right? And try to get some money out of it. So here's an example. Assume equipment acquired at a cost of $25,000 is fully depreciated, meaning it has a book value. When something's fully depreciated, it means it has a book value of 0. Okay. It means that they didn't have any residual value in their calculations and they depreciated off the entire cost. Okay. So in that case, to discard it, all you do is debit the accumulated depreciation account, because remember its normal balance was on the credit side. So by debiting it, you're taking that account to 0, and then credit the asset account. You're taking that to 0 and you're done. Maybe you'd have a note so that somebody looking at it would be like, what were they doing? Well, we're discarding this equipment. It's done. Let's see. Oh, let's see. I think I may have skipped a slide because there were so many slides. They had like 120 in the slide deck, and so I was trying to edit it down to something more manageable. So assume equipment costing $6,000 with no estimated residual value is depreciated at a straight line rate of 10%. The accumulated depreciation balance after adjusting entries is $4,650 on December 31st. On March 24th of the following year, the asset is removed from service and discarded. So what they're saying, so this is just an example of if we remove something from service, not at the end of the year, then the first thing we're going to do is get our depreciation expense current up to the point that we're discarding it. So if you do it on March 24th, it's normal to just consider March fully. Okay, that's just the normal convention. So what they do is they calculate by saying if it's $600 a year, which we figured out by a 6,000 cost, and they're depreciating 10% per year, and then we're just doing 3 months, we'll multiply that by 3 over 12. And that gives us $150. And so anytime we discard an asset, we bring accumulated depreciation up to date at the date of discarding or selling, and then we can put in the sale or discard transaction. So then we go ahead and record the accumulated depreciation. We debit that. We credit the equipment for its total cost. And if there's any difference between those two, it's either a loss on the disposal of the equipment or a gain on the disposal. The easiest way to tell, well, there's 2 ways. Some people like to think of it in terms of what did it cost me minus what was my accumulated depreciation, and the difference was either my loss or my gain. Other people like to use what I call the journal entry method, where you put in the accumulated depreciation, because you'll know the balance of that just from your books, okay? And you're debiting that. You put in the cost of the asset, you're crediting that, and then whatever amount you have to put to make the journal entry balance, that's the difference between the two. If it's on the debit side, we know that we debit expenses, so that would be a loss. Any losses would show up on the debit side because it's an expense, any loss you take on a sale. If it shows up on the credit side, that would be a revenue or a gain, okay? So there's 2 different sort of ways of thinking about it. So when we discard an asset prior to it being fully depreciated, we're going to have some difference. a loss or a gain on that depreciation. And if it's a discard, it's always going to be a loss. If we sell it, it could possibly be a gain, right? If we sell it for a certain amount of cash. So here's an example of selling one. Equipment purchased at a cost of $10,000 with no estimated residual value at depreciation on a straight line method of 10%. The equipment is sold for cash on October 12th of the 8th year of its use. The balance of the accumulated depreciation account as of the preceding December was 7,000. Preceding December was 7,000. The entry is up to date. So the first thing we have to do is we have to bring accumulated depreciation up to date at the time of sale. Okay. So on December 31st, it was 7,000. We're selling this on October 12th. So we're going to consider 9 months worth of depreciation. We know that it's a $10,000 asset with no residual value, 10% straight line. So we're going to take 10,000 times 10%, which is 1,000, times 9/12, which gives us $750. That brings our depreciation expense up to where we need it. After we do that, we can figure out the book value of the asset. So if we depreciated 7,000 and we just did another debit of 750, we now have 7,750 as accumulated depreciation. 10,000 was the cost minus 7,750 gives us our 2,250 book value. So now, in this case, they paid us exactly the amount of our book value. So we're going to debit cash for the amount of cash we received. We're going to credit accumulated depreciation for on the equipment, and I'm sorry, debit accumulated depreciation on the equipment and credit equipment. And as long as we're in balance, there's no gain or loss on that one, right? So think of it this way: if you sell an asset for its exactly what its book value is, there'll be no gain or no loss. If you sell it for more than its book value, you'll have made a gain. If you sell it for less than its book value, you'll have made a loss. Okay. So here's an entry to record a sale of an asset below book value. We sell an asset for $1,000. And it has, oh no, yeah, so we got $1,000. So we're debiting the cash. So I almost always write these for my brain. I debit the amount of cash I received. I debit the accumulated depreciation. I credit the asset account. And then I look for what the difference is between the two. And that's either my loss or my gain. Here's a piece of equipment that we sold at a gain. We got 2,800 in cash. So again, I debit 2,800. I debit the accumulated depreciation. I credit the asset. And in this case, once I've done this, this, and this, I see the difference is I need to add 550 on this side, and that's the amount of my gain. Okay. Okay, now they shift gears on you. Not only do we have to track fixed assets, but we also have to track natural resources. And instead of using the term depreciation, we use the term depletion. Okay, it's the same idea. It's the recognizing that we determine our depreciation rate by saying the cost of the resource divided by the estimated total units of the resource. So if you have an oil well and you're pumping oil out of it, the only way to really do this is to have some expert come in and say, we estimate the amount of reserves in this well as this amount. And so then you say, okay, well, it cost me $10 million to have this oil well set up and dug and everything. And we think that there's 10 million gallons of oil or barrels of oil in it, or whatever term they're going to use. And then your depletion rate would be, in this case, $1 per each barrel that you pull out. Okay. And so that's the idea there. So here's the Karst company. They purchased mining rights. There's a mineral deposit that cost them 400,000. There's, they think, 1 million tons of the resource in there. And they think they're going to mine about 90,000 tons a year. So they take the cost of the resource, 400,000, divided by the estimated total units of the resource, 1 million. That gives them 40 cents per ton. Then each year they can say, how many tons did we mine this year, and take a depletion expense for that. Okay. So, yep, it's pretty much the same as the whole units method of depreciation. Okay. All right. Again, we read it as depreciation expense and accumulated depletion. Okay, so I mean, it really is, they just use a different term. Patents. You guys know what a patent is? Roughly, at least. It is a legal recognition of property right granted by the US government for a US patent, or granted by a government, okay? Usually for inventions or improvements of inventions. So if I create a new invention, if I create a new drug that cures COVID, right, or something like that, I go and I apply to the patent office and say, hey, I want protection for this so that nobody can recreate it. And so that patent, because it gives you kind of the exclusive right to create and sell it for usually like 20 years, it has a lot of value depending on, you know, what it is, what the product is. And so again, it's an asset, and we do the same thing, except now they call it amortization of patents and other what they call intangible assets. Amortization. Amortization is pretty much always done as a straight line thing, but it's still the same concept. You take the cost. If there's a residual value, there usually isn't for amortization, but if there is, it's the cost minus the useful value divided by the useful life. And then each year you divide that off. So here's several different types of intangible assets that businesses can face or own. Patents, copyrights. Again, that's sort of the exclusive right to benefit from something you've published. Okay, a trademark. Think of like the Nike swoosh. Does that have value? For sure, right? And so, you know, they paid a company like $7 million to develop that for them. And I think maybe if I was back then, I would have been like, $7 million, you guys, what a bunch of losers. You just got like screwed on that deal. But I'd say they've done pretty well with their swoosh trademark. So it was probably worth whatever they spent on it. All right. And then finally, goodwill. And goodwill is different because we don't amortize it. And don't worry too much about it. There might be one question on your homework, and just read about it in the book. In other words, it's not something to invest a ton of energy into understanding goodwill on a deep level unless you're going to go into a very specific side of accounting. All right, so this is just to show you how these things look on a balance sheet. You'll see like property and equipment, less accumulated depreciation will give you the net property and equipment. That's the book value of that. Okay, so that's how it will be listed on a balance sheet. This one shows goodwill, and you'll see there's no depreciation on goodwill. And then sometimes in the notes, they'll break down that property and equipment into a bunch of smaller categories. One ratio, I think just, yeah, one for this chapter, which is fixed asset turnover ratio, which is the number of sales dollars earned per dollar of fixed assets. The logic behind this is that fixed assets are really they only exist for the purpose of helping me generate revenue. Or else why do I have them, right? So in the case of my storage buildings, those buildings are there because I can rent space in them. So I'm generating revenue from them. So we just take our sales and then divide it by the average book value of our fixed assets. So that would be the cost of the asset minus its accumulated depreciation at the beginning of the year, plus the cost of the asset minus its accumulated depreciation at the end of the year, divided by 2. That'd be the average book value of the assets. Okay, the higher the ratio, the more efficiently we're using our assets to generate sales. Okay, well, that's the idea behind it. What's interesting about this is if I have the same number of sales in year 1 as I do in year 2, there'll be depreciation expense that just automatically happens each year. So my ratio will be climbing even if I'm not doing anything different. So I don't know if I believe it's that good of a measure of efficiency, but that's the concept behind it. And that's it. Super simple, right? This chapter is a little confusing, usually at first, but usually you slide into it pretty easy once you get the idea. Double declining throws people off a little bit at first because it's so different from the other two, but it's not bad. All right, have a great day. Tomorrow's the lab day, so it's an optional day. I'll see you if you want to be here. Yeah, just one second. Sorry.